Hey, good morning, traders. This is Webull. Netflix after earnings on July 20th, 2022. I want to focus on here on the implied volatility crush and to show you an illustration of that. So the stock has gapped up 3.3%. It's coming down. I mean, yesterday after hours, this stock after its earning, Netflix was up to 220. Now it's at 208. So here for me, it's a question of how long it's going to take for Netflix to fall below 200 as well. But that's not really the point. The point of this video is to show you the implied volatility crush. So here the implied volatility as of yesterday was manipulated to go all the way to 200%. You know from the article on successful trading on what is implied volatility and how to overcome to beat implied volatility, IV crush, that this phenomenon takes place, and the best stock really for this is Netflix. So the markets will be opening in 5, 4, 2, 3, 2, 3, 1. The market is open. Here's the implied volatility of Netflix on here. I'm going to bring in the implied volatility constellation to see that, hey, as of the July 22nd, the implied volatility was as high as over 200 versus much lower than that typically. So this is something that you have seen before on there. So for us on here, let's come back to the numbers and we are looking on the put side on here. But my friend, did you see here implied volatility after just literally the first minute is already minus 100% implied volatility change here on all of these options. So some of these contracts, let's look at the put side here. The put side have lost 80% of the value already. That's huge on here, right? So for me, actually, if you ask me, I really want to go for this as of now. I want to be buying this contract here. I just bought the 170 puts on this thing, but it's not just on the put side, right? So on the call side, we have told you that implied volatility is crushed on both directions. So here, these are deep in the money contract where implied volatility, people are losing money, right? So let's say you had the 200 puts, the calls, whether you thought you will be making money today. No, my friend, you are losing minus 40%, 45% already in the first minute for contract that are deep in the money. What was the cost of this contract? So imagine you're losing 50% on this contract. It's $6. So we are talking about this row here is the 205 calls. They are in the money. So yesterday they were costing $14, and right now, my friend, you can get them for $6. This is just one of those scenario on here that we wanted to showcase for you and to answer the question, oh, how long does it take for the implied volatility to drop down after the earnings? In the case of Netflix on here, we are only 2 minutes in, so we're gonna try to make this video maybe up to 5 minutes to see how low that this is going. So in the meantime, QQQ is flat. Most likely they're waiting the earnings for Tesla, and for which you're going to have another implied volatility crush, right? So this is what's for us. We told you about a minute ago, 200, 209, thereabouts on Netflix, with implied volatility being crushed all over the place. That's the purpose of this video here, as the stock is settling in. But I mean, it will just continue going lower and lower. So these numbers, they were 200% yesterday. As of now, they are 100%. So there is no range, as you know, no limits, no maximum value for implied volatility. It can go as high as we have seen things in the 500, 600 on stocks such as GME. Here for Netflix, in this case, we have seen higher. I mean, 240% that we started with this morning, and that was the case yesterday, is not the highest number that we have seen really. But yeah, so deep in the money contract, calls in this case here, they are losing 60%. Well, the 205, they are now no longer in the money. Let's say the 200. The 200 are still in the money. They are worth $8.60, but they are losing 47% compared to the value yesterday. This is the very, very definition of implied volatility crush post earnings on here. And the best way to illustrate that is the stock of Netflix on here. We have shared that with you on numerous articles. So we wanted to capture that live here today day trading Netflix to illustrate what is the impacts, how does implied volatility crush affect the pricing of the the option price, right? So deep in the money calls, and the stock is up, yeah, but is losing almost half of its value. That's it could not get any worse than that, folks. This is what we wanted to share with you on here. I will just be stopping on here in a few minutes, so maybe let's give it a couple of minutes. We want to go maybe all the way to 10 minutes in to see exactly how it settles. I mean, the stock posted a low price of 200 and something, and now actually it's trying to rebound. So the stock is rebounding a little bit. I mean, 5 minutes in is still too early. I reckon that these guys, they can go I mean, sub 200 for me for the rest of the week is definitely a possibility. I mean, even today, right? $2 on a stock like Netflix is not a big deal. I mean, they have already done the damage for the most part by just deeply killing this call. Let's pick, for instance, the 190 calls, which are $13 in the money, right? How much have they lost? Oh, they have lost 32% of the value, worth $15, folks. Yeah. Imagine trading that yesterday, banking onto, oh, let me get in the money contract and think that I'm going to be making more money. Market makers have have a different idea on this. So you are losing money this morning on Netflix due to implied volatility crush to the tune of implied volatility has changed minus 100% across the board. Either you are deep, these are out of the money. Actually, some of these contracts out of the money, the 250, I mean, they never get a chance, right? They have lost already 93% of the value, and the implied volatility there is minus 75%, minus 80% range. So that's what you have seen on here. The deep one in the money, let's say 160 minus 100%. So thereabouts. We'll just continue to watch it here briefly, and then to conclude on this video on implied volatility crush on Netflix post following the July 19 earnings. And no making money. So this is the call side. The put side, I mean, it is the same effect, right? The same effect. I mean, the price of the puts, it's just that the price of the put, they lose money because the stock went up a little bit. But in terms of the implied volatility, look actually here. In this case, let's say the 205, there, those puts are there in the money. They lost 60% of the value, folks. Yeah, implied volatility minus 105, minus 106. So if you know this, then you know how to recognize potential implied volatility crush and not to trade those stocks. Yeah, you don't trade those options before earnings when implied volatility is just is increased to the tune of above 150. It's definitely no. I mean, anything above 100, you really need to be careful on buying those options. This is what we teach here at Successful Trading. We hope you have a great day, and we're going just to post this video. Thank you. Bye-bye.